Good morning, traders. My name is Christopher Vecchio, currency strategist with Daily FX. Today is Monday, September 21st, 2015. These are your FX headlines as we turn the page to North America. And the US dollar index is making quite the stand today, trading up at 11,965 after last week's wipeout post-FOMC. Seems that market attention has already started to turn to what other central banks might do in response to the Fed's hold. Now that the Fed has lowered its glide path for interest rates, the future expectations of policy, we now see that other central banks are getting ready to push back against what could prospectively be a weaker dollar environment. And so the focus already now is on the euro and what may happen with the ECB there, now trading 112.71. Investors are really taking notice now of those comments made last week in context of what happened in early September. Now last week you had two members come out, ECB's board member, Benoit Cœur, who came out and said that the Fed's decision to hold vindicated more or less the ECB's own dour assessment on global growth. And likewise, you have the ECB chief economist and executive board member Peter Praet saying that the ECB could expand its easing program if the shocks that are currently affecting the market deemed to be longer lasting than previously anticipated. So when we look at those comments and we talk about what happened in September, the ECB lowered its growth and inflation forecasts for this year and the next few years as a result of what had been a little bit of a stronger euro in the middle of the year and the reignition of weaker energy prices. Right now, it actually makes a lot of sense that the ECB may be greasing the skids for an expansion of its QE program. And that could come in a number of ways. They could change the composition or scope of the bond purchases. They could theoretically say, okay, well, all these bonds are now eligible to be purchased as well. They could increase the run rate or size of the program. Currently, the run rate is 60 billion euros per month, and that could be obviously increased 70, 75, what have you. And then, of course, they could increase the length or duration of the program. It's currently expected to run through September 2016. That could be pushed back to December or March 2017 or September 2017, etc. But in any case, the ECB has plenty of policy tools at its disposal to continue to push down bond yields, especially in the core, which in turns will force investors to take on more risks, either by investing in peripheral debt or going into European equities or putting that money abroad. But in any case, as we've seen earlier in 2015, when the ECB is effective at pushing down nominal yields and boosting inflation expectations, it reduces the appeal for the euro. So euro dollar here, 112.66. We're seeing maybe this idea start to unfold in the market. We talked about it over the weekend in our weekly euro trading forecast note. We've also seen it come up a number of times already today from a number of bank research notes. Expect to hear it in financial media sometime shortly. As a result, it could be a view that gathers pace pretty quickly. And you know what, with the market pretty sour on the possibility for the Fed to raise rates this year, only about a 45% chance per the Fed funds futures contract for the month of December. You know, there is some room for interest rate expectations now to come back in and support the greenback. They were taken out very, very quickly last week, and so if the market starts to price in a chance of a Fed rate hike amid better data, you know what, probably helps lift euro dollar or lift the dollar versus the euro amid this backdrop of perhaps the ECB coming in to ease more. And adding into that, if euro dollar rallies almost reflexively, a euro dollar rally increases the chance of the ECB easing because a euro dollar rally will in turn tighten financial conditions. Beyond euro dollar trading back below 113, the focus today is the US dollar index. It's challenging the downtrend from the 9.7, we can call it the 9.9 and 9.15 highs. Right now 11,966. The indicators on this 4-hour chart starting to turn higher and encroach those median levels. See here, stochastics just peeking through that 50 point, and MACD differential is widening to its widest point really since the burst higher back at the end of August here. But we need to see this crossover into that positive territory. Getting on the other side of the moving average envelope would be helpful. We've broken through the 5, but we need to get through the 21 above 11,985 today. We may have a more reasonable belief or outlook to say that this is where we see the US dollar index bottom. Of course, when we made the move lower last week, we didn't quite get to the lows. That would be off the trend line. So some would speak, if we do fail here, it could open up the possibility for a move or one more leg lower down to say the 11,840 area. But the next few days around here are pretty important. You can see dollar yen actually is something that we're interested in the near term. Dollar yen consolidating in a pretty symmetrical triangle here as we attempt to figure out whether or not the pulls of higher equity markets and a weaker dollar will find resolution. But of course, if we see that the BOJ is going to be under focus like the ECB for more easing, dollar yen could easily see a next leg up. And when it comes to shorts in the market, remember this is a market where there are very few yen shorts as of the week for September 8th, 2015. There were only about 6.6 thousand net short yen contracts still in the books. Much lower when earlier this year there were about 70K on the books. So yen shorts could easily come back in. I know there's a lot of risk on the table right now with Chinese financial volatility and those concerns reverberating around the globe. But if those calm down now, dollar yen, even with the Fed on hold, could start to inch its way up. So I'll be watching this week for a break, for a more confident break of 121.73, the swing high we had on 8:30, or lower than that, the 4-hour low we had on 8:24 there. Not the one from the initial 9 a.m. wipeout with equity markets open, but the one later in the day at the close. All right, and that would be right near 118.21. So just some things to keep an eye on for today. Euro dollar, dollar yen. You can keep an eye on the S&P 500. And that too is looking like a triangle here after this larger breakdown. Dollar yen might be guided by that. Not necessarily, causation one to the other, but we expect dollar yen and S&P 500 to move together. So we'll be keeping an eye on that development here. Overall, dollar index may be putting up a stand worth keeping an eye on in the early part of this week. If you want to get in touch with me, feel free to reach out to me through the Daily FX Real-Time Newsfeed, StockTwits, and Twitter at CVecchioFX. You can always email me, cvecchio@dailyfx.com. If I don't speak to you before then, good luck trading the next few days. I'll be back tomorrow morning at 6 Eastern, 10 GMT in Daily FX On Demand. I'll see you there.